Ever wonder if you could actually retire a decade earlier just by using the power of compounding? It may sound like a dream, but harnessing compounding correctly can dramatically accelerate your savings. In this video, we'll explore 4 powerful ways that compounding can work for you, helping you potentially retire 10 years sooner. Whether you're new to finance or well along in your career, understanding these compounding strategies will set you on a smarter path to building wealth. Compound interest might sound like a big, complicated term, but at its heart, it's simple. It's when your money earns money, and then that earned money earns even more money. It's like a snowball rolling down a snowy hill, picking up more snow and growing larger and faster as it goes. The longer your money has to grow, the bigger it gets. By learning how to use different forms of compounding in your financial life, you can turn small sums into a much bigger nest egg over time. Let's dive in. 1. Compound interest in savings accounts and bonds. The first way compounding helps you retire earlier is the classic compound interest in savings accounts or bonds. When you deposit money into a high-yield savings account, a certificate of deposit, or a government bond, the bank or issuer pays you interest on your deposit. In compound accounts, each time interest is credited, your future interest is calculated on the larger, updated balance, your original deposit plus all the interest it has already earned. This means each year you're earning interest on more money than the year before, making your savings grow faster and faster as time goes on. For example, imagine you save $10,000 in an account that pays a steady 3% interest per year. After 1 year, you'll have $10,300. In year 2, that 3% is applied to $10,300, giving you about $309 instead of $300. By year 3, you're earning interest on $10,609 and so on. It might not sound like much at first, but as decades pass, these growing interest payments can turn a modest savings into a substantially larger balance. In fact, compound interest is so powerful that even a small increase in the interest rate or a few extra years of saving can dramatically boost your final total. People sometimes overlook this because savings interest rates feel low nowadays. But remember, it's still free money that you wouldn't have otherwise, and it's guaranteed growth. Because it's low risk, compound interest accounts are perfect for the foundation of your savings. Choose accounts with the best rates you can find. Online banks and credit unions often offer higher yields than big banks. Even if it's just a couple of percent, these accounts will quietly do the heavy lifting of growing your money for you year after year. 2. Compound returns through stock market investments. A more powerful form of compounding comes from investing in the stock market or other growth assets. Here we talk about compound returns. When you invest in stocks, mutual funds, or index funds, your money has the potential to grow at higher rates than a savings account. As your investments increase in value, any dividends or profits you earn can be reinvested to buy more shares, which in turn earn their own returns. This creates a snowball effect for your portfolio. Think of it this way. Suppose you invest regularly in a broad market index fund. Each time the market rises or the fund pays a dividend, you reinvest that money into buying more shares. Next time the market moves up, you have slightly more shares growing in value. Over 20 or 30 years, these reinvested gains can really multiply your portfolio. For a rough example, if the market returns about 8% on average, your money would double roughly every 9 years, thanks to the rule of 72. That means an initial $10,000 investment could become nearly $20,000 in a decade, $40,000 in 2 decades, and so on, without you adding a cent more. Of course, real life will have ups and downs, but the long-term trend has historically been upward. Stock and fund investments carry more risk than a savings account, so the growth isn't guaranteed each year. But the big advantage is the higher potential return. Historically, stock market returns have been substantially higher than bank interest rates, which means a much faster growing compounding effect over the long term. Also, if your employer offers a 401k match or similar benefit, that's essentially free money that boosts your contributions. Every dollar of employer match and every reinvested dividend adds to your compounding base. In essence, you're using the power of the economy and time to make your money work for you. Over decades, this kind of compounding can make a huge difference in how quickly you build wealth. If you're finding these compounding insights helpful and want more strategies on building wealth and smart finance, go ahead and like this video and subscribe to the channel. Your support means we can keep sharing valuable tips to guide you toward financial freedom and that early retirement dream. Let's get back to the video. 3. Compound contributions and increasing your savings rate. Compounding isn't only a passive benefit. You can actively boost it by increasing your savings contributions over time. This approach is sometimes called compounding your contributions. The idea is to save consistently and, when possible, save more as you go. For example, whenever you get a raise, bonus, or any extra money, commit a portion of it to your savings or investments. By doing this consistently, each new contribution starts earning returns along with the rest of your investments, effectively accelerating the compounding process. To illustrate, let's say you normally transfer $300 from each paycheck to your retirement fund. If you get a raise next year and increase that transfer to $330 per paycheck, that extra $30 every cycle will now be earning interest or investment returns too. It might not seem like a big change in the short term, term, but over 10 or 20 years, it adds up significantly. In fact, many financial experts note that how much you invest often has a larger impact on your long-term wealth than small differences in return rates. That means you have a lot of control. By simply investing a few dollars more every month, you're multiplying your compounding power. Even small steps make a big impact over decades. Think of adding pebbles to your snowball as it rolls down the hill. Each pebble is an extra $10 or $20 a paycheck you redirect into savings. Over the years, you have a lot more snow, money to push, and each piece continues to grow on its own. You could even automate this. Many retirement plans allow you to schedule yearly percentage increases in your contribution. By making saving a habit and a priority, you're ensuring that a growing portion of your income enters the compounding cycle. Over time, this discipline and consistency can massively speed up your progress towards your retirement goal. Finally, the fourth way to compound to retire earlier is to leverage two key factors: time and tax advantages. Time is literally free fuel for your compounding. The earlier you start saving and investing, the longer each dollar has to grow. For example, imagine two friends. Alex starts saving $200 a month at age 25, and Sam starts saving the same $200 a month at age 35. If both save the same amount every month until age 60, Alex will end up with significantly more money, even though he saved fewer years. That's the magic of time. Those extra 10 years of compounding can roughly double your final total compared to starting later, assuming similar returns. On top of time, using tax-advantaged accounts is like a turbo boost for compounding. Retirement accounts like 401ks, traditional or Roth IRAs, and health savings accounts, HSAs. HSAs allow your investments to grow without annual taxes chipping away at the gains. In a regular taxable account, you might owe taxes on dividends or capital gains each year, which means some of your earnings leave your investment. But in a tax-sheltered account, every bit of growth stays put and earns more in future years. For example, if you invest $6,000 in a Roth IRA, any growth from that investment is completely tax-free when you withdraw in retirement. So 100% of your gains compound year after year. Even traditional accounts or HSAs give big advantages by deferring or eliminating taxes. Health savings accounts deserve a special mention. They can act as a triple tax-advantaged investment if your employer offers one and you qualify. Your contributions are pre-tax or tax-deductible. The money grows tax-free, and withdrawals for qualified medical expenses are tax-free. That's an extra layer of compounding benefit. The point is, when you give your money as many years as possible to grow and shelter it from taxes, you maximize the compounding effect. Even if you're a bit older now, it's not too late to benefit. By aggressively contributing to these accounts and starting right now, you multiply your compounding effect. The sooner you start, the more you benefit from both time and tax advantages. By leveraging all four of these compounding methods together, you can significantly boost your retirement savings and potentially retire much earlier than you ever thought possible. Each of these techniques adds up. You earn interest on your savings accounts, let your investments and dividends grow, continue adding new money to the pot, and give it all plenty of time to expand without tax penalties. Over time, the combined effect is exponential. Remember, compounding is a marathon, not a sprint. Stay consistent and patient. Small choices today, like opening that high-yield savings account, setting up automatic investments, or contributing a bit more each year, will look huge in 10 or 20 years. The beautiful thing is, your younger self is already giving your future self a gift by making those smart financial decisions now. Keep that snowball rolling by making good financial habits a priority. Each year you stay the course, you get a little closer to the freedom of an earlier retirement. Now it's time to put these ideas into action. Pick one strategy and implement it this week. You might surprise yourself at how fast you can accelerate toward that goal of financial independence.